When you borrow money from a financial institution such as a bank or any other lender, you need to pay a fee back to that lender for borrowing their money, and that is called interest. So you won't just pay back the money that you borrow, but you pay back a little bit more interest, and that's how banks and financial lenders make their money. Sometimes this is done with simple interest, and simple interest is done at a flat fee, and it doesn't build up over time, so you don't earn interest on your interest. So there are some loans that work like this. This is the formula. So the interest amount you'd need to pay back is equal to the principal amount, so the amount of money you borrow. So you might borrow $20,000, for example, to buy a car. That would give you an interest rate. A lot of interest rates float between, 4 and 10%. So they might say your interest rate is 5.5%, let's say. And then the time in years. So you might intend to pay this back over 4 years. So that may be the period of your loan. Quite simply, putting those numbers into the formula will calculate the amount of interest that you would need to pay back. Here's a question involving simple interest. You borrow $24,000 from the bank on a simple interest loan to buy a new car. The interest rate on the loan is 6.5% and the period of the loan is 5 years. You're going to repay the money back in 5 years. If you repaid the loan back fortnightly, calculate the amount of interest. So that's the first thing, the amount of interest. The total to be paid back. So the total amount you need to pay back to the bank. And the last one is to calculate the fortnightly payment amounts. So we'll do that in a different color. So the fortnightly payment amounts, because you're paying it back fortnightly. For the first one, calculate the amount of interest. Interest is calculated by interest is equal to PRT. So interest is equal to the principal. So the principal is the amount that we start with on the loan, so $24,000. So 24,000 times by the rate. So the rate is 6.5%. Similar when we're working with percentages, we're actually going to multiply it to its decimal equivalents. So 6.5% as a decimal is equal to 0.065. I've done that by dividing by 100. Percent per 100. That's why. So the rate in this case is 0.065. The time of the loan is equal to 5 years. We're going to repay the money back in 5 years. Important, time always must be in years when we are putting it into this formula. If I now do 24,000 times by 0.065 times by 5 on my calculator, I get the answer of 7,800. So that is the amount of interest that would be paid back, $7,800. For the second part of the question, the total to be paid back, that is just simply going to be equal to the interest plus the principal. The total is going to be equal to the interest plus the principal, because we borrowed 24,000 and then we've had this $7,800 of interest put on top of it. So that's the total we'd have to give back to the bank. So the original was 24,000. We add the the interest on top of the principal. $24,000 plus $7,800 is of course equal to $31,800. So that is the second part. That is the total that needs to be paid back to the bank. Principal plus the interest. The final part of this question is we want to calculate the fortnightly payment amounts. So often loans are paid back in fortnightly or monthly or weekly installments. So fortnightly payment amounts. The time that this loan is over is 5 years. In 1 year, there are 26 fortnights. I know that because there are 52 weeks in a year. So if I then therefore multiply that by 5, I'm going to get 5 years worth of fortnightly payments. So if I do 26 times by 5, I can work out that there are 130 fortnights over a 5-year period. So therefore, to work out how much I'm going to pay back every fortnight, I am going to do the total amount, which was the principal and the interest, and divide that by the loan period, and in this case it is in fortnights. So simply I've already got those two values. So I've already got the total amount, which was here, and I've already got the loan period, which was here. So what I'll simply do to work out the last one is I'll do $31,800 divided by 130. That'll share it evenly between those 130 fortnights. So in this loan, I'm going to plug in $31,800 shared evenly between those 130 fortnights. My repayments are going to be equal to $244.62, rounded correctly to 2 decimal places. So for that last part, all you need is that total amount that you need to repay to the bank, and just work out, depending on whether it's weeks, months, years, fortnights, whatever it is, how often are you repaying it back, divide it by how many there are. So there was 130 fortnights in this case. $13,000 of simple interest was accumulated at a fixed interest rate of 4.75% over a period of 5 years. What was the principal amount that was invested? We know that it's simple interest, and the simple interest formula is interest is equal to the principal amount times the rate times the time. We're actually given the interest in this case. The interest is $13,000. We're actually trying to find out the principal amount, so we're just going to leave that as P. That's multiplied by the rate. So a rate of 4.75%, we need to change into a decimal, which is going to be equal to 0.0475. Dividing by 100 gets it as a decimal, so 0.0475. The time in this case is 5 years, so multiplied by 5. So 13,000 is going to be equal to P times by, and what I'm going to do here is I'm going to do the rate, which was 0.0475 times by 5. So that's going to give me the answer of 0.2375. Now, using our algebraic knowledge, we now need to try and get the principal on its own to find out what P is equal to. So to do that, we need to do reverse operations. So on this side, we can see that we're multiplying by 0.2375. So if we divide by 0.2375, they'll be able to cancel out because anything divided by the same thing is equal to 1. To balance the equation out, we must do it on the other side of the equal sign though. So we need to divide 13,000 as well by 0.2375. Therefore, we will have the principal amount, or P, on its own. So 13,000 divided by 0.2375 is equal to $54,736.84. That's rounded correct to 2 decimal places. So originally, the person had invested $54,736 at that interest rate over 5 years, and that would accumulate, if you put it back into the original formula, $13,000 of simple interest. As we saw in the previous question, we can rearrange the formula on any question. So we could rearrange it to work out not only the interest, but the principal, the rate, or the time. So if you read this quite carefully, Sam had a simple interest loan, so the formula still applies, for his laptop. He borrowed $1,500. So in this case, he borrowed $1,500. That is his principal amount. And ended up repaying a total of $1,860. So if he paid $1,860 in total, if we, thinking of these two numbers, $1,860, if we took away the principal amount of $1,500, we would find that the interest on his loan is $360. So in this case, we can put that into the interest part of the formula. So $360 is equal to $1,500 so far, times by over 8. We're looking for the interest rate. What was the interest rate? So in this case, we don't have a rate, so that can stay as R. But if you read the second part, and ended up paying a total of $1,860 over a 2-year period. So that's in years, we can put it straight in 2-year period. What was the interest rate of the loan? We can then go now and try and figure this out. So, making it a little more simply, 360, I'm going to multiply 1,500 times 2, which is going to give me 3,000. We'll make this a little easier, times by R. Now, thinking about reverse operations, to get the R on its own, we're going to need to divide both sides by 3,000, because 3,000 divided by 3,000 is 1. 1 times R is R by itself. So if we do 360 divided by 3,000, then we should get the interest rate. So, using my calculator, 360 divided by 3,000 is equal to 0.12. Our interest rate needs to be expressed as a percentage though, so to turn it into percentage per 100, we need to times that by 100. So our interest rate was 12%. The keys to remember, regardless of how you're putting it into the formula, is that the interest that will be accumulated is equal to the principal amount, the amount that's originally borrowed or deposited, times by the rate. The important thing is that we always need to change and be able to change between percentages and decimals. Finally, when we're using the time in simple interest must be in years. So just be careful if it says that they do it over a 24-month period, you'd need to change that into years. That would be 2 years. If they said it was over a 36-month period, change it into 3. Simple interest, the time must be in years.